All right, well, happy Monday. The markets started a new week with a small grind to the upside. Very typical day within a bullish convergence. So I'm going to talk about what that means. We've been looking for this type of move over the past week. We're now knee deep in it. So I'm going to describe it, what it means, why it looks the way it does, what to expect. Can we expect more days like today? Coming up here into November expiration and back out of it on the other side. So we're going to break all that down. We're going to take a look at a big move today in the US dollar and long-term bonds and see what that means, what kind of impact that might have on expectations going forward, and what that means for equities and which sectors within those equities have been moving here lately. And we're going to take advantage in one of those areas with the stock and potentially start a new trend trade in that particular sector. So let's go ahead and get started. Today is Monday, November the 15th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see that a little bit of a down day today, not very much, right? I mean, we were, 500th of a point is all we lost today. That is it. 46.82.85 to 46.82.80 today. We did have a little bit of a range, but well below the average. Kept the near-term line from getting solidly into the reversal zone. You see it, we got up to about a quarter point above 80. The momentum line right in the neutral area, not really up or down. Of course, intermediate posture is still strongly bullish because it's above 80. Doesn't matter which way it's going. It's above 80. It's strongly bullish. Market sentiment line is rising in bullish territory. So, we've got the indications of a little bit of a market sentiment run. We actually never did end the current one. And we're on this intermediate run right now. Obviously, we turned dark green shading back here in the middle of October. We're now into the middle of November. So we're 1 month into this current intermediate rally that we're on right now that typically lasts 1 to 3 months. So, we've already had kind of the length of time that we typically, now granted, we've only had the two near-term runs, right? This was one big near-term rally that started the intermediate run, and now we're on a new near-term rally. The question is, how long will this one be? As you can see, we're already starting to converge a little bit towards the moving average, down to the 3% mark. And the moving average is going to start really catching up here relatively quickly. If you take a look at some of the other major indexes, you see very similar pattern, though the Dow's near-term line is coming from a much lower level than what we saw on the S&P, and it's not quite in bullish territory yet. The NASDAQ 100 came off of a little bit of a dip into the lower reversal zone. Now it's just a smidgen up above the 80th percentile. It did get a cluster here at the beginning of its run on that last near-term rally. And then the Russell 2000, whose intermediate line is the closest to actually falling out of the upper reversal zone. The near-term line bouncing out of bearish territory, but not quite getting into bullish, as we're not really coming off of this low very much, and technically would still be on a near-term pullback because the near-term line, never did get up here to the upper chart. So, we still have a strong bullish posture. Everything still is okay. We're still in kind of some, whether we're still in the near-term decline on the Dow or the Russell 2000, or whether or not we are actually in a near-term rally on the NASDAQ or the S&P, and how long will that rally last? We talked about that we'll probably kind of grind into expiration close to these old highs. Whether or not we get higher or lower, and how long the near-term line stays in bullish territory on this run remains to be seen. Usually after big long runs, it's hard to get another big long run coming out of it. It tends to be pretty choppy with short moves up and down, but still maintaining bullishness, right? If you recall, we are still, we still have a bullish candle. Last week we didn't quite close above the high, so that's a little sign of convergence, though obviously we don't have a red arrow, nowhere close to getting a lower shadow or red arrow, or even a negative differential down here with a falling PPO. So we're not anywhere close to a pullback on this chart, but we are still in convergence mode. Like we're below the MACD's moving average, we're below the stochastics moving average, we're still above the 8-day moving average, so that's just because we're converging doesn't mean we drop, right? We are still just kind of grinding at a really slow pace to the upside with really slow ranges and very small moves. We have 0.03 of a percentage point there. So if we take a look at some of these different oscillators, you can see they're still in bullish territory. Like we're still well above 60 on the S&P. The CCI is above 0. If you look at the Russell 2000, remember it's the closest one to dropping out of the intermediate line, dropping out of the upper reversal zone. It's also the closest one to dropping below 60 on the RSI, and then below 0 on the CCI. Remember, that's when you start getting into more, at least you're not in bullish territory anymore. You can see the NASDAQ 100 is still look at that big RSI that we had, and we're still easily up above 60 there. If we take a look at the directional movement index, again, the breakout, the trend ends when both lines, when the positive line gets below 25 and the negative gets above 20. The negative did briefly get above 20 there, but not even more close to ending. So the ADX is still very strongly higher. When you look at small caps, it's a little bit closer to ending, right? We're a lot closer to the 25 line there. We're already flirting with 20, and you can see the NASDAQ looks very similar to the S&P 500. When you look at the trend strength indicators, we saw a mature, strong trend on the S&P and the NASDAQ 100. The diamonds as well, above 5 and above 80 down there. And then IWM, you can see same thing, above 5 and above 80. The IWM, out of all of them, is the only one that's below its Tenkan line, the green line. Well, the Dow is a little bit. The Qs are up there, and then IWM, you can see it's kind of breaking down. They're all easily above the blue line. The red line's well above price, so we're nowhere near pullbacks, but we're definitely in a convergence mode where the trend is still there, but just really, really slowing down to the upside. And that's kind of my expectation here going forward. You can see we gapped up, we filled in the gap up there, so we're just kind of, we had a higher high and a higher low, but we didn't close above the high, so not so bullish. When you look at IWM, we had a higher high early in the morning, then we had a lower low, and we actually closed below the low. So an outside day with a close below the low point. That's actually relatively bearish. We're still in last week's range, but you can get the idea. See, we're closed, higher high, higher low, but closing above the prior day's high, and the same thing on the Qs. So the three large cap indexes all were showing bearish signs, but just not, bullish signs, but just not as bullish because we didn't close above the high. IWM is an outside day and actually closing below the low, so relatively more bearish there. And you can see not very much volume down below. It's a little bit some there at 234, but really not a whole lot until we come down and fill in that gap down there from 1029. When you look at today's volume and trading range, you can see again we don't have 3 green arrows on any of the indexes now, so we're clear on all of these. They're all 2 red arrows actually, so we are obviously in convergence mode here. And then when you look at the volume was 47 million shares, well below the average, 2.58 points. Again, when you put those numbers in the context, 2.58 well way down here, 42 million's way down here, so we're already almost a 3/4 of a point on the ATR to price ratio, which is extremely low. And then of course the volatility index, which made a little bit of a run last week, but then finished below 80%, closed below 80% again for a second consecutive day. We kind of had a stretch over there where we had multiple days finishing below the 80th percentile, and then we started to rally. So but you can see we're back below the 80th percentile, but again well off this 15 level. So we're extremely low in volatility. It's really hard to break that 15 when we're already so extremely low to the downside, and that's the issue that's going on. So again, what that means, you get those big moves and volatility breaks down, and if volatility can't break down, we just won't get the strong moves to the upside now. There'll be more grinding. It'll be slower. We'll see, we might get higher highs and higher lows, but we won't close above the prior day's high. The weekly candles aren't, Hakinyashi closes aren't closing above the prior week's high. The MACD and stochastics are trading below their moving averages. It's a very typical bullish convergence period. So the expectation is we'll still go up. It'll be slow. It'll be up and down. We'll go up a little bit because we take 3 steps forward and 2 steps backward. But that's the nature of the beast. That's what a bullish convergence is. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am? Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us 2 things. Number 1, you liked our video today. And number 2, you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like our videos, you don't have to click on anything. But if you do like them and you want to let us know, hit that thumbs up icon. You can do that right now even while you're watching. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these things over here on the right. Click on this icon right here. That will take you to our Market Outlook live video page where I review all the trades from previous Market Outlook videos to see whether we should stay in them or get out of them. We talk about why and how. We also put on today's trade idea that you'll hear at the end of the video tonight. We already put that on here before the market closed at 3:30 Eastern time. We do that Monday, Wednesday, and Fridays on this page. You can see all the old archives right there. Also, if you come down here, you can see our upcoming classes. Click on this View More, or you can click on Trading Rooms up here at the top. That takes you to our calendar with all of our upcoming classes, all recordings, going back 3.5 years. If you come down here, click on this heart. That opens up a new tab. Hit that like button. Also click on this thumbs up icon right there. It opens up another new tab. Click that like button. Again, the more you do that, it really helps us out, get all our content out to more of our followers that follow our accounts, and because of all the engagements it has. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. Alright, now let's take a look at what's driving the price action. You can see over the past few months, commodities are still your big winner. They're still holding a lot of gains, so they've been relatively flat for the past couple of weeks. Small cap stocks and the Qs have peaked, at least for the last week or so, and have been relatively flat. You can see gold is up and the dollar is up and bonds was up and then back down today. Let's take a look at just today alone. Here we'll come down to November here, the 15th. And you can see how we did today. Today real estate was up and the dollar was up really big. Very interesting patterns. You can see bonds were way down, which means bond yields took off to the upside. A lot of pressure on equities. Not by the end of the day, but for most of the day, you can see all that pressure there. Let's take a look at some of those charts. Let's take a look at the Euro US dollar. And again, you can see the big downward move already hitting 113.75. That was kind of the target we thought we would hit. And it's interesting that, again, the dollar has been really bullish pretty much since really taking off to the downside on June the 16th. It's been a very, very bullish run. But if you look at how different asset classes have performed since June the 16th, coming forward here, and then we'll leave it there. We'll go out to a daily chart. So there's your first day, June the 16th, the big rally on the dollar. So the dollar's been up over 5%, which is a big move, as you can see from the currency. When you look at the currency chart here, let's just go to this chart and look at the Euro US dollar here. And you can see it's a really big outsized move there. I mean, that's your first big downward move, and then from then on, let me just make sure I got the right dates on this one, and it's not the 15th. We'll just check it out just to be sure. Yeah, the dollar, we didn't have the big move there. We had 2 consecutive gaps there on the 16th and the 17th, so we got it there. So over 5% rally, and you can see though that interestingly enough, as during that big sharp drop or rally in the dollar, drop in the euro, it's been a bullish. Like look at commodities that were really bullish. The Qs were really bullish. Bonds have been relatively bullish. The only thing that's really struggled is emerging markets, which is actually what you'd expect, and gold also, which is what you'd expect, struggling a little bit too. If you take a look at the major currencies here, to kind of see how they've performed. Here, nope, not that one. We want to do the comparison, so it'd be. I can find the right one. There we go. Going out from June again. That since the dollar started to peak and rally, so basically about 5 months here. There's the big drop in the dollar, the big move to the downside. You can see, interestingly enough, the dollar was bullish, but you notice the euro, which is what we're looking at in that chart, was by far the weakest. In fact, some of these commodity currencies the dollar's up against them, but not nearly to the extent. So really, most of that euro-US dollar drop is mainly weakness in the euros. The euro is down against everybody. Very, very weak pattern, and that pushes the dollar higher, the dollar index higher, because the dollar index is made up of 60% a euro-US dollar currency pair. So keep that in mind when you look at the dollar drop. In this case, it's mostly euro weakness than it is dollar. There's some dollar strength in here, but it's really a lot of euro weakness, and that's why you're not seeing a risk aversion trade, which is what you normally see when the dollar is so strongly bullish. Usually that's a big time safety trade. You can see we've got another cluster of clusters down here. We're more than 1% below the 30-day moving average, which is in the 14th percentile. Big clusters down here. The very oversold short-term sentiment, very oversold momentum line. In fact, the last time the momentum line got into below the 5th percentile was over here, and when we got a cluster of clusters as well, and that actually led to a rally in the euro. So weakness in the dollar, and obviously some actually relative strength in equities during that period. So interesting to see again what the dollar's doing, kind of coinciding with strength in yields, as the yields have bounced back up, and very strong close today, back up to 1.623%. It's actually a really good sign, because when you look at the 2-year yield, you'll notice that it was up to 52 basis points. So the yield spread now, when you look at the 10-year minus that 52 basis points, now we're back over 110 basis points difference. It's a very good sign. Remember, that's as the yield spread rallies up to hopefully 250 basis points before the Fed starts raising interest rates. That gives the Fed a bigger runway to land that airplane before they invert the yield curve. So very, very good sign for the 10-year yield. And then when you look at like long-term bonds, which is a little bit it's not quite the 10 years, a little bit longer, but still bearish. And you can see very bearish short-term sentiment, more bearish than we've seen in a while. Last low point we had was that was this low was down here, and we're kind of flirting with light pink shading and a yellow line right now. So we'll see how that plays out. Of course, commodities have been following yields higher, and that didn't, gold or commodity or crude oil, was up 1% today, but not quite the most bullish run, and we're not really, breaking back up here. So it's something to keep an eye on as a reflection of risk appetite. And here in the overnight session, Bitcoin is really getting hammered, and it's down. It's off of its lows, but it's down. Below its 30-day, has been kind of flirting with its 30-day moving average here in the overnight session. So we'll see how it plays out once we get into the regular trading session. But you can see, even if we were to break the 30, there's quite the gap before it even gets to the 50, much less down to the 200-day moving average. It's been that bullish, and you've got some pretty decent support down here at these lows, at this divergent low, right, with higher highs with the lower highs here on these oscillators, as well as on the RSI CCI here. You can see the the lower lows, except for the CCI had a little spike above 200, but lower lows in the RSI. So you got some support at that low point in between the two highs, that divergent high points. Of course, breaking that, now you're going to be more in a bearish posture, more of a bearish posture than we've seen for quite a while in Bitcoin. It's been so strongly bullish that you're just barely getting light pink shading in the yellow line, which is actually a bullish signal, as you can see there on the chart. Let's take a quick look at the sector rotation before we look at our trade idea of the day. And if you take a look here at the sector comparison chart, we'll just take a look at today alone. So we'll come over here to November. You can see the big winners today, interestingly enough, were two sectors that don't normally go hand in hand. And also interesting too to see utilities so strongly higher on the day where yields were up. Usually it's strongly higher on the day that yields were down, and bonds are up. But you can see financials struggle with a strong day in yields. That's not normal. Materials, healthcare, technology, discretionary, all down here at the bottom, and staples and real estate outpacing some other cyclical areas. So kind of a relatively risk-off day, and with energy being kind of a underperformer that has now bounced back up. If you take a look at the last week in general, you can see why XLE did so well, because it was one of your worst performers. Now XLY is one of your worst performers, and your safety trades, including materials, which was the big winner going into today, is one of your bigger losers. So if you look at the 12 grid here really quick for the major sectors, you can see that technology still got some outperformance to go, and discretionary is giving some of it back. But look at the strength in materials here with a very strong intermediate line up above 90. Same with industrials. Energy has been converging along with financials. And then your safe havens really all picking up and showing dark green shading in the green line. So everything is kind of moving up here, except for some cyclical areas that have really been converging, including communication services, and to a lesser degree, just over the past week, consumer discretionary stocks. So for our trade idea of the day, I wanted to take a look at Newmont Mining, gold miners. One of the gold miners in that material sector has recently broken up above. We gapped up a few days ago, coming out of earnings, where we established kind of a low point here, kind of a little bit of an inverse head and shoulders pattern, and we're breaking through the neckline and going up to new highs. You can see dark green shading in a green line. We're almost 5% above the moving average, which is a good strong move. There we are, the intermediate line getting up above the 80th percentile, the market sentiment line getting out of this lower reversal zone and starting to work its way up too. The long-term charts here have been relatively bearish, and now the last couple of weeks showing some good bullish candles and flirting with that 200-day moving average. Here's what it looks like on the 2-line basis. We are up above the 8 and 17-day moving average. And you can see a little unique difference in this go around than the last time we had a good little rally. Is last time the 30-day was well below the 50. This time the 30-day is crossing above the 50. So a little bit of a mini golden cross there as we fill in potentially the rest of this gap up to the 200-day moving average, and then we'll see if we end up getting a golden cross again on the 50 and the 200, since we're kind of in a death cross environment on it right now. Also a little bit of a difference here too. Previously, the last peak got us into the Ichimoku cloud. This rally is getting us through the Ichimoku cloud, and we're really close to 2 and 65 on both these indicators down here at the bottom. That would suggest the beginning of a new intermediate trend. And then when you look at like the directional movement index here, you can also see too that we have had a very low ADX. It's rising as we had the positive index getting above 30 here recently. The negative index staying well below 20. So what looks like it may be the beginnings of a slow trend because we got so much volume above us. And so what we decided to do here is to buy the at-the-money option out into March expiration, so that 50 to 150 days range, closer, since we're doing a long call, it'd be closer to the 150 days range. Buying the at-the-money strike price, which is the $60 strike in this case, got the most extrinsic value, and then setting your stop order at 50% of that. So that's the working order that we still have there, the sell order at 50% of the stop order. The entry order that we got in there about $3.30 today. So that's the trade that we'll let see if we keep going. We've got about a $575 risk here on the trade. Because you keep in mind that we're not risking $330, we're only risking 115. So 115 times 5 is about $575 there. And then if we do get up to the upside here, then you're looking at about a almost $3,000 reward if we get up to 69, which again to kind of give you an idea of where we're at here. March expirations over here, so getting up to 69, which would be this where this old 0% level is. I'm not quite remember where that was set at. Looks like it was set way back over here on that peak. So let's see if I were to remove that and draw it on the recent declines down to this little point here. Getting up to 69 would be getting back up to, let's get rid of that one too, right up into this area, right up into the 62% retracement, and maybe a little bit above that, and trending towards that $70 range, where getting through 70 would be the beginnings of a long-term trend by that point. So a good opportunity here for a nice, slow developing, very low time decay. Very, very low time decay, only $6, and again out of $575 at risk. So we have the ability to kind of let this thing grind upwards if we like, and buy some time to let the kind of mini golden cross play out, and then eventually potentially lead to more of a longer term golden cross between those 50 and 200 day moving averages. Alright, well that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums, where you can open up any new thread with any questions or comments you have. Reply to anybody else's threads, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Click that thumbs up icon, like us on Twitter and Facebook as well, comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.